Hey, look, I'm coming in late last minute to save my man Mackie. Sorry, it's a little hot.
Yeah, Mackie didn't want to face my wrath on Abercrombie. That's why he's not here.
On what? Amazon?
ANF, Abercrombie and Fitch. That's okay. I never blame anybody for not buying the stock. It's 100% me. I think I talked about it 5 times on the show in the last 6 months, including the 2 times I bought it.
I have a little update, David. Since the last time we talked, I bent the knee on the silver.
All right, so hold on. I'm trying to.
You're back in it
here.
No. I covered the risk reversal. I took the L. You know what?
Okay.
This thing looks like it's going to $85. Like I don't want to waste my energy on my holiday worrying about being short something that's literally going vertical and not stopping. Gave it a shot, you know.
Right.
I don't know, Robert. You're a pretty good guy, but
chicken shit markets, the silver and gold works. Everybody's buying high and trying to sell higher.
Yeah, I mean, hey, look.
I don't even know. I think the
works
is around $15 or $20 an ounce.
I have a new stock idea that I'm thinking about. I can chat about a little bit. I pitched it once last year also, and I'm thinking about getting back involved. I also need a haircut badly.
Hey, I just talked about how I got a haircut yesterday. So there you go. We're all in the markets for haircuts.
Look at this mop.
Yours might take a little longer.
Hey David, I did have not too long ago, maybe like 6 years ago, I had hair down to my shoulders. I'll send you a picture of that so you can appreciate that.
Little Lord Fauntleroy.
The problem with that is when you have curly hair and it's long, it's an absolute disaster. I have full respect for the ladies and how long it takes to do their hair if you have curly hair.
All right. Well, yeah, haven't had to worry about that. I haven't had to worry about that for about 30 years. So,
so you're like, I don't know what you're talking about.
Yeah.
All right. What are you doing over there, Marcin?
I was trying to show you a college beard I had and hair. I had hair and beard once. I look like Mountain Man.
All right. So let me.
Okay, cool. Send me the picture on WhatsApp.
I will.
All righty. Should we get started? Should we wait a little bit? So,
you just got it.
Okay. Well,
where do you start?
Well, this is Wall Street Beats. It's December 17th, 2025, closing out the year. Half the people listening or on the show would like to just close the books for the year and be like, hey, good year. Let's move on to next year. But we're here. You're here. So let's get started. Robert Marcin, Ben Bry. Robert, I do want to start with you, see what checking in on you. We talked a little bit before the show about one of your stocks, but you have a new one for us. I can't even pronounce it. So maybe you'll tell us the name and then tell us the symbol, because I don't know spelling. It's going to help me.
Yes, the ticker, it's Itafos, ITFS, ITAFOS. It's a phosphate producer, which is fertilizer. And it's a $2 stock. It's in the high-ish end of the range, but it hasn't done much for a decade. 200 million shares, so it's a $400 million market cap, about $550 to $600 million in revenue. And the last 5 years, they will have averaged about $150 million in annual EBITDA. So there's net cash. So it's under 3 times normalized EBITDA EV. Doesn't trade a lot. It's headquartered in Houston, Texas. The mines are in Idaho, and they produce phosphate rock, and then they turn it into different phosphate related diammonium phosphate fertilizer and specialized phosphate liquids and all kinds of fertilizer related products. And it's a very neat business. It's a one property, one mine company, which is always a risk, but it's very strategic. And Mosaic or any of the other publicly traded fertilizer companies that are 10 times bigger than it could snap this up in a heartbeat. So, what's the fundamental story on why I like it? Well, the phosphate production in the U.S., I think in 1980 was 50 million tons. The last year it was 20 million tons. So it's an asset that truly does deplete and has been depleting in the U.S. for a long time. It's more valuable and rare and precious than ever in the last 50 years. So it's an asset. I'm not a big commodity guy, but I think of this as almost like a specialty commodity. Not a pure, even though it is a global pure commodity. The U.S. protects the domestic production with tariffs. Morocco and Russia are two of the biggest producers and exporters. They've had tariffs for 5 years and should be re-upped next year. And the price for diammonium phosphate is around $600 a ton. The range the last 5 years has been about $450 to $1,000 a ton. So it's come down a lot from where it was 5 years ago. And last year it hit 800 last year. So the price risk in the commodity itself, as far as what optically it looks like, has been de-risked, in my opinion. So I think, I don't think they ever participated in the financials in that $800. It was only there for a quarter or so. So I don't think they benefited from an outlier pricing structure for the commodity. But phosphates are the most important fertilizer, one of the most important fertilizers out there in our food production system. And it's just a very they have 7% of the domestic market from this mine, and they've pre-sold the volumes at market prices to J.R. Simplot, the potato farming company. So they don't even have to worry about revenue growth over the next few years. All they have to do is hope the market holds up in pricing, and they're going to print 100 to 150 million dollars in EBITDA over the next annually over the next 4 years with this contract with J.R. Simplot.
All right, so it sounds like a super boring but steady company.
Yeah, I would say it's probably worth 4 to 6 in a transaction if they ever wanted to sell it. There is a couple of issues. They have to decommission a mine. It's going to cost them money. Their main operating mine in Idaho has fully depleted. They've switched over to a new mine that is a temporary mine and has similar cost of production. It lasts them about 10 years. So if that's all we had, I don't know if I'd be buying this. But they've discovered another place to produce on the property, and they're in the process of starting to invest this year and next year to extend the mine life. They say it would extend the mine when they develop the second new mine, because they're already on the first new mine that's in production now. It would extend the life of the mine to at least 2050, so another 25 years from now. And that's just in their mind. In their mind, there's enough mineral base at the property to last through the end of the decade. So, or the century. So probably through 2010, through 2100. So they're not pressed for resources. They do need to spend capital to develop the mines, and these things are not cheap. They might take $100 million to develop over 3 or 4 years, but that's well within their capital spending budget.
So just stepping back for a second, when we talk about, you have a number of these kind of single digit, smaller cap companies, when you're thinking of your portfolio for like the coming year or so, how many of these do you own at a time? Is it because they're a lot of work? Are they larger position? Like, is this a larger position for you? And how many of these do you have?
This is just a starter position, and that's just because I just had it pitched to me. I crowdsourced ideas off of Twitter now and then, and a portfolio manager that owns it pitched me it a few months ago, and I've been following it. It had run to 250, and I basically said, I'm not even thinking about it. 250 at $2. I'm back interested. I bought a very small amount just to get started, but I share what I do in real time, so that's the last trade I made. But I could have a 2, 3, 4% position in some of these right now. Koru Medical is one of my top 3 positions, and Saragon is in the top 7. And I don't mind the $2 stock doesn't bother me. At $2 or 200, what matters is the enterprise value. What matters is the revenue and the EBITDA and the earnings and the cash flow, right? So if a company had 1 billion shares in a $2 stock, it wouldn't. If it had, I try not to do much under 100 million in market cap, and it has to be a liquid 100 million. But in my portfolio, at any one time, I probably have 3 or 4, 3 to 5 of these positions. So I might be a little higher than 5 now, because large cap and mega cap and growth at any valuation range has sort of gotten too expensive. So I've been forced down into the small and nano cap parts of the stock market. Although, I passed Abercrombie and Fitch 2 weeks ago or 3 weeks ago, and that was a mid cap. So it's not like I talked about it and said I was going to buy it, owned it 2 other times, talked about it 8 times on the show over the last 6 months. But, so it's not like I'm searching for nano cap.
Remember, you can still get into Bath and Body Works, the close relative. That may trade similarly. Remember, Berta
between the difference between Bath and Body and Crocs and American Eagle and all those is they were not half EV to sales, and they were not 3 times EBITDA. They were 5 or 6, and the 5 or 6 which I own haven't worked. So
now this potash company again, what's their symbol?
Phosphate. Sorry, phosphate fertilizer. Yep. ITFS. ITFS is the ticker symbol.
Okay. ITFS.
S isn't Sam.
Oh, S. Okay. ITFS. Got it. All right. Well, I'll keep an eye on that one.
I'm just throwing it out there as something I just started buying small, with a $2 stock price.
It reminds me of a company I used to own, SLCA, which ended up going private, but it was a sand company. No one covered a sand company that literally made sand, and they were taken out unexpectedly for a good premium, not a retire rich premium, but a good premium. And I think companies like this, again, could just be consolidated up. So interesting.
This company shouldn't be public, basically. It should be part of another company, another fertilizer company.
What were you going to say, Ben?
I was going to say, did I pitch Bath and Body Works, or did Berna? Because I don't know if I said that on the show, but I bought that in November. I didn't know if I mentioned it on here or not. It's about $20 today.
Berna acted on your recommendation.
Actually, yes, you're right. Now I remember correctly.
She called me about it. She called. I had the idea. So I had this idea of looking at it in the beginning of 25, and I'm glad I didn't do anything because it went down 50% from there. So one of those like cheap kits, cheaper things. And to be fair to Robert, he always kind of was like, well, if you got a lot of leverage, cheap can always just keep getting cheaper, right? And I don't know, they had like the big Bath quarter in November, and it was down 20%, and bought it like, I don't know, $17. I don't know. It's one of those things that that's like kind of dumpster diving a little bit, but everyone, Jeff couple of guys I work with are all like, everybody's at the mall. Apparently, these millennial or not millennial, but whatever you call it, the young kids,
Gen
Gen
Zs.
Z or whatever, they love the mall again. So I don't know. It was simple thesis, but that's working a little bit. But I do have a cheap stock that's growing for Robert. So Robert, no one's forcing you to go into nano market like illiquid caps. No one's forcing you. You're like, there are things to do. So let's talk about PayPal. Okay, so Charlie and I were talking about the evolution of the banking system and finance, because yesterday or 2 days ago, Visa announced that they're going to do stablecoin settlement on their network. Okay, and I was like, oh, and so I started reading about it, and then started thinking about this Clarity Act and how PayPal had basically applied to be a bank, and Coinbase trying to be applied to be a bank. But the thing about PayPal is it's got 435 million customers, 228 monthly active customers. For reference, like JP Morgan has 75 million customers. Okay. So if these guys can become a bank, you could start and they could start taking share in deposits. I'm going to try and frame it, but I'm just starting to think about it. This is a stock that trades at 11 times PE that's growing earnings. And it's a big cap. It's 60 some billion market cap, and with the call option potential of turning into a bank and converting some of those already existing customers. I don't know. It's like, I think it's worth it's putting my cap on. But in a world of where people are like, oh, there's not a lot of cheap stocks or whatever, this kind of strikes me as something that's interesting. And I just for full disclosure, I pitched this somewhere in the 60s on this show, I think in the spring of 24, or maybe the summer of 24 it was. But anyway, and it had a nice little run, and then it got stopped in its track in the 80s, and then now it's back at 62. But 11, 12 times earnings, and that's not including any of this potential to convert to a bank. So I don't know. It's worth putting.
It's really interesting because the acquisition cost for customers for banks is a key component that people look at. And here you have you don't have built-in banking customers, but you already have their phone numbers and email addresses,
right?
And so hitting them over and over. I was involved with this company. My brother was way more involved. He did a early stage, I think Series A for Dave. And that's a stock that SPAC'd out at 10, then went to 5, and now is $202. And that's an all virtual bank, young people, but they've had to go out and get customers. And they're at a $3 billion, $2.5 billion market cap. So you have PayPal that's, already has in these these customers. So that's really interesting. I'll have to think about that.
Yeah, I mean, what is the old thing at banks? Like they give you like a free fruit basket, or like some jelly donuts or something, like as that part of that customer acquisition, or they take you on like trips and stuff. But yeah, you're right. Like getting customers. I mean, look, we have a subscription business here at Wall Street Beats. It's hard to get subscribers, hard to get customers. So if you were to have built-in customers that you can have built-in potential new earnings power that's you can layer on it, I think it's kind of an interesting thing, especially sitting here at 11 times. Now, I'm far from an expert on this stock. This is kind of me like talking out, like thinking like out loud of like something I'm looking at that's worth thinking about. But I don't know. It's hard to like get crushed buying 11 times earnings on a pretty big international business. So that's actually growing earnings. So I just think that's the kind of thing that, it's the holiday season's coming up. Maybe do some work on it. Take a look at it. Not like, you're pounding.
I looked at it 60 last year or a year and a half ago myself, and I passed because of the revenue growth. But if they can grow revenue, I don't know if they can do double digits, but if they can get, high single digits, that's a very cheap stock.
Yeah, my only worry with PayPal is the friction of fees and whether or not new market entrants are coming in with like no fees, or like Zelle is no fee, and then are there other competitors that are going to keep fighting on the fee? So their base business of taking a rake on the transfer of money, will that go away? So it's interesting though.
I think
Yeah,
that's
like
why the
and
stock is 11 times earnings. Market
yeah,
trading
Yeah.
company.
exactly. Like I think that's right. I think that it's like there's a decent amount of look in a mark. What does the S&P trade at? 24 times, 23
Yep.
times, something like that. Like
Sure.
in a yeah, okay. So it's trading at 60, 70%, 50%, depending on what your number is, discount to the market. Uh, there's some bad news priced in there, I guess is all my point is, and like if there's a new potential for growth because of a regulation change, and let's be clear, this administration is definitely cutting the tape of things to try and get banks and people to lend money and get the economy off its ass, for lack of a better word, for a lot of the economy, not the top of the K or whatever. Could be interesting. I don't know. Look, again, it's got no net debt and it's $60 billion cap. 9% free cash flow yield. So,
Mhm.
when I was a young analyst, I had a PM tell me that every, the free cash flow yield, if you have a 1% growing business, should trade at a 9% free cash flow yield, 2%. It's like as a rule of thumb. And so, if it is really just growing top line at flat 1%, low single digits, you could probably say that it's appropriately priced. But then again, like maybe this embedded call option is not there. And so that's more of what I'm thinking. And then again, it doesn't take much to get under owned stocks to like look again at Abercrombie, like Robert said. Like that thing was left for dead. No one wanted that. And then it doubled in like 2 days or whatever. I
Yeah,
think
like
2 weeks.
if I said to you they get the approval to be a bank, how much is the stock up? I mean, that's pretty easy math, right? So the fact that they might move toward that or do that, we know what the next big catalyst is. The more they talk about it, the more people are going to go, okay, well, what's the TAM, right? That's the thing that analysts do is, oh, the TAM, and they always overestimate that. But they'll be okay, so it's everyone who has a bank account. All right, so how much share do they need to get? Okay, how many customers do they have? And I'm always amazed that so many, especially young people, have no problem in just, I don't need to be, I can be at Dave Bank, I can be at Robin Hood and have money there. They're much less worried about I have to have a big name brand bank. So PayPal as a bank wouldn't scare anybody.
Yeah, and again, you think about, okay, well, there's two sides to being a bank, right? You have to have assets. If you're gonna have deposits, you have to have assets. Just buy treasuries. You just buy bonds. You don't even have to go out and be in the lending. But they have a small business credit component, just like Block does, and some of that stuff. So they could get into the private credit business. And I don't know. Anyway, that was
Do
kind of what I'm thinking. Go ahead.
do they own do they own Venmo?
They do, which is very popular.
Very popular.
So again, like I don't see Venmo going anywhere. I don't see PayPal or Venmo going anywhere, and they're. It's just like, can you convert? That's so. I think ultimately it's one of those things where that's why I say it from like kind of a macro beta level idea that like checks a few boxes, but like to get excited, you got to do a little more work and you got to dig in a little more than I've done. But I just popped on with you guys and I was just thinking it, and I
Yeah, but
think it's worth
but one
like
of the things that for people who are watching, one of the things that jumps out is when you said, look, they have a high free cash flow yield. So when you think of these sideways moving stocks that are kind of what's the option here, they're very low multiple. What you're looking for is sort of a margin of safety, and with a high free cash flow yield, unless that's going to go away, that gives you some sort of like, okay, I can wait now because uh, the stuff won't hit the fan because they have this base of cash flow coming in. So
Yeah, I mean, now you have to do something intelligent with it, right? But I think that it's no one's going to blame you for buying back your stock when you're at a 60% discount to the market. You know, like there's a lot of things you can do that are value accretive when you're making money and you know aren't a bad steward of capital that can help you win and give you that margin of safety that you're talking about, David, right? Like, because theoretically in 2 years, if they have no growth but they produce that cash, they should have, you know, your value should go up by 15 to 20% roughly, right? And so if there is erosion, it can offset that erosion in some sense. That's why some of these really, you know, like think about like RR Donnelley or some of the tobacco companies like that have negative organic like volumes, little pricing. They always take forever to go away because they're producing so much cash, right? And like you see the business organically declining, but they just have a way of lasting for a long time because
Yeah.
of the cash flow generation.
And if you think about it, I mean, the government's done everything they can to kill those businesses, and or at least the tobacco companies. You know, let's tax something so high, so much more than it did 20 years ago, and guess what? They still throw off cash. So it's like you
Yeah.
can't kill those, you know, certain businesses.
No, that would be about correct. All right, well, guys, it is getting closer to the holiday. Can you believe that it's the end of the year? I mean, Robert, got to give you little flowers. You were saying stay the course all year. Your IWM close to the all time highs.
Respect the rally was the phrase, Ben.
Yeah,
Since the spring, I expected the correction. I got whacked way more, and I didn't buy as much as I should have from the cash I built up in advance in April. But by May, I had spent most of my money, so it wasn't terrible. It was a very good year for nano caps if you bought them right. So now, Ben, David, if you're not talking the stock, you're only hosting. I wanted to talk about OpenAI because did Ben and I we obsess about OpenAI because I think it's a scam, and I heard the other day. Did I read yesterday that they're paying up to 50% of their revenue in stock comp because they can't afford to pay regulars in cash. So if they're really, I read that a Bloomberg reported it, 50% of revenue in stock comp. That's nuts. You've got to be an idiot to own that stock in a private equity form, in my mind, at today's valuation. So I don't know if that's true or not. I just read it on Twitter. So if it is true, it's very dire for the whole OpenAI ecosystem, in my mind, because I suspect they'll run out of money in the next year if that's the case, if it's that bad.
I mean, it is kind of crazy when you think of like so in September when we were talking and I was telling you like you know I'd done the math on these Oracle and CoreWeave and Meta and the whole thing, and I was like, yeah, the streets got this wrong, the cash flow situation, and they were getting all those circular, you know, oh, we'll invest in you and we'll invest in you, but they're just like letters of intent. Yeah, and it was just like banana land. And so since then, we've seen, you know, the credit markets start to reprice things, and over $100 billion of credit be put out there. I mean, you saw that Blue Owl backed off on those guys on that data center today, on that $10 billion data center. So you know, is SoftBank stock's been drilled? Like, are they going to back off? Because you know, it's one of those things where when you go up the Christmas tree and the Ponzi, like it all works, but then you go the other side and you're like, oh, I'm out of here. Sentiment changes, and if you don't have the cash flow, like OpenAI doesn't, to Robert's point, you know, these other guys have, Google has cash flow, right? Microsoft has cash flow. Even Meta, who's spending like a drunken sailor, has a lot of cash flow. So, you know, those guys, they might be overspending right now, but their business they're not putting their business at risk. Whereas CoreWeave and Oracle, they're not quite, I mean, CoreWeave maybe, but Oracle's like close, but you know, they're risking a lot, right? And that's why you're seeing the credit spreads blow out there and their equity get just absolutely smushed. So yeah, I mean, go ahead, Robert.
You know what this comes down to? It's a very simple concept. Okay, this AI thing, if you want to call it that. It's the bulls always revert to and you see the companies talking about this. There's an infinite demand for compute. Oh, if I had 10 times more compute tomorrow, I could use it, right? That's sort of what it comes down to. And that's I agree. That's 100% true. But the consummated transaction in this world, you need two things, right? You need the desire to purchase, which exists. I'll purchase all the compute in the world for free. Google can give me all the compute in the world. I'll take it for nothing. 10 times, I'll take 1,000 times more than they're giving me now. Okay. But you have to have the ability to pay, right? And the cost of developing this compute is not economic at the market's willing to pay for right now. Now there's going to be real cost savings, real productivity improvements, yes. So the improvements on nominal GDP, if they're 5%, 2%, 3%, that's real money. That's hundreds of billions or $1 trillion over time. But there also needs to be revenue to support it, and the business model for generating a revenue is far from certain. The product winners are far from certain. So people placing these valuations on these businesses, in my mind, were insane when they peaked. They're probably still insane today. But I don't think the ability to pay for an infinite supply of compute exists. And I don't know if anybody knows the ability to pay for compute, where that is in the business model.
So I have my own behavioral economic theory or behavioral finance theory about all of this, that very few people are actually trying to figure out the economics of it all. But it's like Wall Street tends to, if a portfolio manager has experience with something and they like it. So let's think of like $20 salads, and then you may take that company public. They go crazy for it because you know what? I've had sweet greens. It's wonderful. And they're like, I'm going to be all over that. Or BlackBerry in the day. Like, oh my God, I have a BlackBerry. It's amazing. So people started using these large language models, and they're like, this is amazing. They're finally got the blinking on their VCR set, off. Now this is something they can use. They can type in like, tell me about this, and it talks to them, and they're very excited about it. And it is exciting. Like, I'm not trying to downplay that it's amazing, but they're like, okay, so I need to own this because this is a Da Vinci moment. I need to own the next light bulb. And there are so few companies, and so they throw money at it. And you get these wild, things that just then they back into, well, why does this make sense? And I agree with you. Like, you can own Google because on a dime they can change their mind and say, we're not doing this. Or you could say, I'm not a fan of Apple technology, but let's call it what it is. They have embedded users that will always buy iPhones, whether they have Siri that answers things or they buy it from someone. They don't care. There are better ways to play this from a stock standpoint without the risk of, hey, my credit default swaps are blowing out like Oracle, and I might be setting myself up to not exist.
Yeah.
And so I sit back and I go, gosh, I understand there's a limited number of things that people invest in for AI right now. That doesn't mean you have to invest in the limited number, though. It means you could wait and find the next, oh, this is the application. Oh, I bought IBM for it, or I bought something else. So
Well, and also let's just mention the historical precedent of tech. Let's just for a second, which I'm not convinced of, but let's just give this technology, this token-based auto regression that we call AI, which is not AI. It's just it's an auto-regressive process with low information density. Let's just give it to them. It's going to be this great thing. Well, historically, all these times when you have the internet, telephones, railroads, you can telegram, like autos. The early investors usually you have to get smoked first, before you get the real winners. Like in the early days, even Amazon, which made it to the other side, did a 96% drawdown. You know what I mean?
Right.
And they ended up being one of the great. So yeah, you held it, but there's not many people who have a 96% drawdown wherewithal in them. If we talk about buy high, sell higher, then not a lot of people can handle that kind of drawdown. So to your point, David, if you are going to invest, might as well invest in something that's a little more diversified. That you look at it kind of like, to go back to my PayPal idea. It's more of a call option on top of a business versus, if you want to actually go with something that's a derivative, you go into all these secondary things that flew, but it feels like it's late in the game for a lot of that, right? Like, all these power and the Vertivs of the world, the equipment guys, the HVAC, that comfort systems I talked about a number of times, ticker is Fix. So that trades worked pretty well for, this is year 3. Like, third full year of this. It's not early days, in my opinion.
Yeah, it's it's like Charlie Munger said, the fear of missing out is the biggest, threat, is that everybody fears I'm going to miss out on the invention of this. And it's like, well, okay, you should have invested in OpenAI when it started then, because you probably have missed it from that standpoint. Maybe the derivative is what you want to own. So, but maybe we're just all three old people though.
If there was a way to short AI publicly, I'd be shorted. That's just me.
Well, there is. What are you talking about? Like,
Oracle?
Honestly, Oklo,
NVIDIA,
SMR, Fermi, that piece of shit IPO that like literally was another like one like that just down only IPOs.
Or get Bold. Just go after NVIDIA. I mean, it's printing money, so I don't know if I wouldn't do that, but I could see where someone says, look, at some point they need to just say, oh, by the way, these orders aren't real.
I'll give you an example on the NVIDIA, because that I wrote that up short last summer at 135 or something, and I had 2 drawdowns and made a little money, and then, but like, your point is taken. Like, they're producing so much cash. Like, I've messed around with that and made very minimal money, and so they're whereas like when shorting these bubble stocks in since October, that stuff's off 50-60%. Like businesses that aren't real businesses, when the air comes out, are where you want to actually like be short, not these other things. And who knows? NVIDIA could get cut in half. Who knows? But like, I just think that your point is taken, that there's easier fish to fry if that's your stance.
Yeah. Well, we've gone for a while. We've covered a lot. It's 10:45. We have wallstreetbeats.com. You should go there, check that out. You should go to passes.com/wallstreetbeats. For Ben Bry, Robert Morrison, I'm David Maris. We'll see you tomorrow. Enjoy the holidays, and we're getting close to the weekend. So enjoy the rest of the week.
Thanks, guys.
Take care. Guys.